So, hello everyone, welcome back and good afternoon to everyone in the webinar. I'm really happy to have you again here for the 21st episode of our Digital Trader Summit. It's time again to look into the gas markets this time. I think there's plenty of reasons. Long rise since 1 year now of prices, quite some volatility. I'm very happy to have an excellent guest again with us. Great opportunity to learn today from Greg Molnár. He's with the International Energy Agency and following the market since many years. I think many of you know him as a commenter on recent trends and price moves in the market from LinkedIn and other social media. So I'm really happy to have him with us. It's the first time. Greg, great to have you here. Before I hand over to you, just getting back quickly to the rules, we have a 20-minute presentation from Greg, roughly, maybe it takes a little bit longer. And then we hope to have an intensive discussion with all of you as participants. Please use the chat function or the Q&A function. I will pick up the question and get them into a dialogue with Greg. So please, already during the presentation, feel happy to participate and make this a lively discussion afterwards. Now it's time. Greg, happy to have you. Floor is yours. Thanks.
Good afternoon, Jens. Good afternoon, everyone. First of all, many thanks for your kind words of introduction and for the invite. It is really a pleasure to be here today. And maybe just to start with a personal note, I really like this concept of webinars you launched at enmacc. I think it is a wonderful initiative, and it is a very good way to bringing a bit the energy community together. You know, we have been in different stages of lockdowns, curfews, stuck in home offices for now over a year. So it is always very nice to see these new platforms emerging, which allows us to interact a bit more. So please allow me to share our presentation for today. I hope you can see it on the screen. And the title of the presentation is Light and of the Pipe. And it is based on our quarterly gas market report, which has been published just a week ago and can be downloaded free of charge from our website, iea.org. And of course, there is always some light at the end of the pipe. The question is how bright it is, how strong will be the recovery after the darkness experienced in 2020. The presentation itself is divided into two parts. First, we will have a global overview of market developments, and then we will have a special focus on Europe. So 2020 has been, of course, a major shock to the energy system, and I don't want necessarily to spend too much time on that slide. I just would like to remind ourselves that last year global energy demand fell by 4%, and of course not all fuels have been impacted the same way. We see that oil demand have fallen by approximately 9%. Coal declined by 4%, being squeezed between a lower electricity consumption, expanding renewables, and low gas prices. And if we look at renewables, the green spot, they managed to expand by 3%. And if we consider renewable-based electricity generation, it increased by an impressive 7%. Now, natural gas is sort of in between. We need to acknowledge that global gas demand have fallen by 75 BCM, which is the largest decline on record. But at the same time, it is also rather clear that natural gas demand has been rather resilient for when we compare it to other fossil fuels. And this is mainly because of fuel switching dynamics in the power sector and because of a colder Q4. So on this slide, we can see how global gas demand evolved in the recent past by quotas. We have the largest gas consuming regions, including US, Europe, the Asia Pacific region, and Russia. All together, they account for approximately 60% of the global gas demand. And just to note that most of the demand contraction in 2020 has been concentrated in the first half of the year, when natural gas consumption fell by an unprecedented 4% due to a combination of mild winter weather in Q1 and the COVID-19 induced lockdowns in the second quarter. And what we see is that gas markets started to show the first signs of recovery already in the third quarter of the year. And as mentioned, part of this has been driven by the coal to gas switching dynamics in Europe, in the US, as well as in some markets of the Asia Pacific region, supported by the record low gas prices. In our recently released Global Energy Review, we estimate that coal to gas switching led to 58 million ton reduction in carbon emissions from the power sector in 2020. Now, the combination of cold winter weather, lower nuclear availability, and a gradual recovery in economic activity led to a strong demand growth through the 2020-21 heating season. And we can see that this has been partly driven by the Asia Pacific region, where China's demand grew by over 15% during the gas winter season. And part of this has been, of course, supported by the continued coal to gas conversion in the residential sector and a strong rebound in industrial gas demand. In Europe and Russia, most of the demand growth resulted from higher space heating demand. In contrast with other regions, natural gas consumption in the United States declined almost by 4% year on year, despite of the cold temperatures which have been driving up space heating requirements. And this decline sort of reflects gas-fired electricity generation losing ground on higher fuel prices, with gas burn in the power generation declining by 7.5% over the gas winter period. So how did global gas trade evolve? If you look at the first half of the chart, we can see that pipeline supplies in dark blue reacted first to the demand contraction in 2020, followed by a decline in LNG exports, falling by 7% year on year in the third quarter due to a combination of shut-ins induced by historically low market prices and both planned and unplanned outages. As a result of colder winter temperatures and the recovery in gas demand both in Europe and Asia, global gas trade returned to positive growth and increased by over 4% through the heating season. This has been largely driven by the recovery in pipeline imports into Europe, while lower pipeline flows from Central Asia to China have been compensated by the ramp-up of the Power of Siberia pipeline. In contrast, LNG trade remained subdued, increasing by less than 0.5% over the heating season due to ongoing capacity outages in Australia and Norway, and gas supply availability issues in Indonesia, Trinidad and Tobago, and of course, a temporary disruption of LNG production in the US during the big freeze in February. This in turn led to tighter supply-demand fundamentals. And of course, prices have closely reflected those changing market dynamics. The sharp drop in gas demand in the first half of 2020 led to a collapse in prices, which plummeted to decade lows across all major gas-consuming regions. When looking at the second half of 2020, the story is quite different, with all gas benchmarks recording strong gains through the third quarter, supported by demand recovery, supply adjustments, and unplanned outages. During the heating season, all regional gas benchmarks averaged well above last year levels, while sporadic cold spells in Northeast Asia and the United States propelled regional prices to historical highs. As we can see on the chart, Asian LNG spot prices climbed to over $30 per MMBTU by mid-January, breaking the record price levels seen in the aftermath of the Fukushima accident back in 2011. The cold spell in Asia coincided with lower nuclear availability in Japan, a shortfall in Central Asian pipeline supplies to China, and a range of outages at regional liquefaction plants, including in Australia and Indonesia, which led buyers to call on more distant suppliers, and in particular from the United States. In fact, the US provided almost all the incremental LNG supply to Northeast Asia during this period. And this in turn led to longer LNG shipping routes and eventually to the congestion of the Panama Canal. As a consequence, my tonnage demand went up, the availability of prompt vessels dried up, and charter rates climbed to historical highs of more than $200,000 per day. And this in turn provided further upward pressure on Asian LNG spot prices, which, as we said before, climbed to over $30 per MMBTU. And just 1 month later, the big freeze in Texas drove up gas prices to historical highs. As a result of the exceptionally cold weather, natural gas demand more than doubled in Texas between the 8th and the 15th of February, largely driven by incremental power demand, given that about 60% of the Texan households heat themselves with electricity. Unfortunately, extreme weather conditions led to freezing components at gas-fired power plants and a sharp reduction in gas production, about 45% drop due to wellhead freeze-offs. And this led to a steep drop in gas-fired power generation, leading to rotating power cuts lasting for several days. And of course, this insatiable gas demand drove up natural gas prices to unprecedented highs. While Henry Hub prices rose close to $24 per MMBTU, the price volatility has been even more extreme at local, less liquid, and less interconnected hubs. Prices at Texan hubs such as Katy and Waha settled above $200 per MMBTU, while intraday prices at the OGT hub in Oklahoma soared to an historical record of over $1,200 per MMBTU. And of course, even though these price spikes were short-lived, they remind us that security of supply should not be taken for granted, and highlights that there is an intimate interplay between gas deliverability and electricity supply security. So what is our outlook for 2021? If you look at the gray bars, this is sort of the picture we have been left with in 2020, a decline of 75 BCM, mostly concentrated in the mature gas markets of North America, Europe, and Eurasia. Now, we expect that global gas demand is going to increase by 3.2% in 2021, enough to offset the losses we have seen in 2020 and even result in some net growth compared to 2019. Having said that, this is likely to be a fragile and rather asymmetric recovery, subject to a variety of risk factors, including a slow rebound in economic activity and fuel switching dynamics in the power sector. If you look at the top bar, the global gas consumption, we see that the main contribution comes from the industry, accounting for over 40% of incremental gas demand. And this will be largely driven by the Asia-Pacific region, and in particular by China, where coal-to-gas conversions provide additional support for gas demand besides the recovery in economic activity. The second driver is the residential and commercial sectors. The return to more average winter temperatures and retail activity, together with the expansion of gas connection in China, supports a strong 4.9% increase in these sectors, unless we have a particularly mild end of the year. In contrast, gas to power demand is facing a more challenging environment. 2021 is expected to see limited growth in electricity demand, strong competition from increasing renewable capacity, and lower cost competitiveness against coal, as natural gas prices are expected to recover to above their 2019 levels. So this forecast expects a 1.2% increase in gas to power demand in 2021, not sufficient to offset the drop we have seen in 2020. And this is particularly visible in the United States, where stronger Henry Hub prices are expected to depress gas-fired power generation. Although gas demand is expected to recover globally, regional disparities remain. Most of the demand growth is expected to be concentrated in fast-growing markets of the Asia-Pacific and the Middle East, together accounting for almost half of incremental gas demand in 2021. In contrast, the most mature markets in Europe, Eurasia, North America are seeing slower growth, which only partial recovery for them. And now let's have a closer look to Europe. European gas consumption rose by over 5% year-on-year during the 2020-21 heating season, driven by colder winter temperatures, a higher gas burn in the power sector, and a gradual recovery in gas demand in industry. Heating degree days averaged 10% higher compared to the 2019-20 heating season across Europe's main gas-consuming regions. Distribution network consumption increased by an estimated 6%, supported by the higher space heating requirements in the residential sector. And demand growth was particularly strong during January and February, which faced several hot spells. The sharp drop in temperatures during the first half of February, together with lower wind generation, propelled European daily gas demand to a high of 2.4 BCM, topping the daily gas consumption levels seen during the beast from the east back in 2018. At the same time, gas to power demand increased by an estimated 4% during the heating season. So the decline in nuclear power output, together with lower wind generation, created additional market space for thermal generation, most of which has been captured by gas-fired power plants, while coal and lignite-fired generation remains subdued. And here, just to highlight that Turkey accounted for the majority of incremental gas to power demand in Europe, with its gas-fired power output increasing by 55% year-on-year, driven by lower coal and lignite-fired generation and plummeting hydro availability. And gas demand from industry remained rather resilient, increasing by 3% year-on-year in Italy and averaging at pre-crisis levels in France, despite the imposition of new lockdown type measures. And here again, just to highlight that industrial gas demand has been particularly strong in Turkey, where it rose by over 10% year-on-year during the period between October and January. So following a strong growth in Q1, European gas demand is expected to increase by 3% in 2021, recovering to its pre-crisis levels. The sharp increase in carbon prices is expected to support additional gas burn in the power sector through the summer, while industrial gas demand is expected to continue its recovery amid improving economic conditions. So when looking at the supply side, I think what is interesting to note is that despite higher gas demand, LNG import flows into Europe fell by almost 30% year-on-year during the 2020-21 heating season. the widening price spreads between Asian spot LNG and European hub prices have been driving away LNG cargoes from European shores to Asia since the beginning of September. European LNG imports fell by close to 50% year-on-year in January to their lowest levels since September 18. European LNG imports remained subdued in February before recovering close to last year levels in March. Meanwhile, non-Norwegian domestic production continued to decline, falling by an estimated 10% year-on-year. This has been largely driven by the Netherlands, accounting for almost 40% of the net decline as a result of both lower Groningen output and lower production from its small fields. Norwegian deliveries remained broadly flat, increasing by less than 1%, as lower deliveries to Germany were compensated by higher flows via Emden to the Netherlands and via the Langelet pipeline to the United Kingdom. And Russian net exports to Europe had recovered to above 2019 levels by the end of 2020 and averaged close to 20% higher compared to last year during the first quarter of 2021. Pipeline imports from North Africa rose by over 55% during the heating season, and Azeri deliveries increased by close to 40% as flows via the TANAP and TAP pipeline systems continued to ramp up. And storage withdrawal increased by over 50% year-on-year during the heating season to meet higher gas demand. They accounted for almost 20% of total supply, up from 13% during the same period last year. Consequently, European storage inventories closed the heating season almost 25% below last year levels by the end of March. And of course, colder than average temperatures in early April extended the heating season, forcing some of the storage sites to switch back from injection mode to withdrawals. And as we are speaking, storage levels in Europe have fallen 20% below their 5-year average, with inventory levels now below 30% of working capacity. These low inventory levels could translate into higher gas injections through the summer, providing additional market space both for LNG and pipeline suppliers, and heat up the competition between European and Asian buyers for additional LNG. So I think that just to conclude that presentation, I would like to mention that natural gas demand opened 2020 with a very strong recovery driven by a number of regions, including Europe, Northeast Asia, Russia. But I think it is important to highlight that this has been a weather-driven, mainly weather-driven recovery. LNG exports remained subdued due to a combination of commissioning delays and unplanned outages. And of course, this sort of tightened up the supply-demand fundamentals and added to the overall price volatility, which had been also fueled by sporadic cold spells. And we have seen that particularly in Northeast Asia, the United States, but also in some more regional European hubs, including the PVB in Spain. European gas storage levels closed the heating season well below the 5-year average levels, indicating higher injection demand for the summer 2021, which again can add to this tightening supply-demand picture, which is emerging. And again, just to reiterate that market fundamentals for 2021 remain fragile. global gas demand is expected to recover to above its 2019 levels, but we still see variety of risk factors, including to a slower than expected rebound in economic activity and maybe unfavorable fuel switching dynamics in the power sector. And then, of course, there's also all the uncertainties which are related to the weather conditions. So thank you very much for your attention.
Thank you, Greg. I think this was an excellent overview and quite some good food for discussion. And we see the first questions coming in. I'd like to start a little bit on the top level. We're talking about a global gas market by now. How do you see this evolving? What kind of themes or major trends you see there for this year to come?
Oh, I think that one interesting development when it comes to the global gas market is gas markets have been in the past regional markets, and what we see now is that these regional markets are becoming globalized. So it doesn't mean necessarily that a truly global gas market is emerging, but what we see is that the regional gas markets are increasingly influenced by each other. And just to give a very clear example, the correlation between European spot prices and Asian energy spot prices have been above 0.95 last year. And of course, there have been a debate on maybe that this is something which has been driven by the general oversupply in the market. But what we actually saw is that the correlation between the two has become even more important in the second half of the year, when we already have seen the first signs of market tightening. And if we look a bit ahead, and if we consider what is the correlation between the summer and the winter contracts for between TTF and JKM for 2021, 2022, it is around 0.99, and I think that this is a correlation which we would see, between hubs such as TTF and BP. So I think that this clearly shows that these regional gas markets are now talking to each other, and market fundamentals in Northeast Asia are influencing the price environment in Europe and vice versa. And here I think it is also important to note that the correlation between Henry Hub and TTF and Henry Hub and JKM has been also increasing quite significantly in the last 3-4 years, and in particularly with the ramp up of US LNG exports.
I mean, there are two elements which help the influence between the markets, which is the storage growing as well outside of Europe. I guess there is some influence, and you see as well additional LNG terminals to be built. How do you see that demand developing?
So I think that it is important to note that indeed what is driving this greater influence and correlation. I think that the greater availability of LNG is certainly helpful, but I think that what really matters here is the contractual structures under which this LNG is being traded. We have seen an increase in LNG contracts which are signed without fixed destination, which are flexible and which can be redirected accordingly to the price signals. And we have seen also a growing share in LNG traded on the spot, and which is again basically it follows the price signals. So I think that this is one part of the story. The second is that market players are also adapting to that new environment, and they are increasingly pursuing not a point-to-point logic, but they are considering more an optionality thinking. And I think that this is very clear, what you also referenced, Jens, that in Europe, for instance, we have a lot of regasification terminals, and we see that a number of major players have now booked a regasification capacity in those European regasification terminals, sometimes up to 2050, but clearly with by seeking optionality. Yeah. And I think that this is also a new development. And here, I think another element you mentioned relates to natural gas storage. Mm-hmm. We see that there is an increasing storage capability being built in the Northeast Asian market, and I think that China is a key driver in that. But also we need to consider that building storage takes time, and currently the underground storage capacity of China is 13 BCM. It might increase to 16 BCM by the beginning of this heating season. But it is not comparable with, for instance, the European storage capability, which is around 100 BCM. And we have seen that European storage is also plays an increasingly global role in sort of balancing out the global gas market. We have seen this quite clearly in 2020 when we had the situation of oversupply in the first half of the year. I think that Europe played a key role in absorbing surplus LNG. In the first 5 months, European LNG imports have been climbing to record levels despite soaring demand. And this has been facilitated on one hand by storage movements and also by tuning down pipeline imports. And during the winter season, we have seen sort of a reverse situation, because we had a very strong LNG demand emerging in Northeast Asia because of the cold spell. And of course, the price differential between JKM and TTF have risen to record levels, and the LNG cargoes have avoided Europe and went to the Northeast Asian market. But this again has been enabled with the different flexibility mechanisms which are available to the European market, including ramping up pipeline imports, but crucially relying more importantly on the European storage facilities, which, as we mentioned, accounted for approximately 20% of the supply during the heating season.
Yeah. Very, very interesting. We get lots of questions around the price levels, actually, and one goes in the direction you described, or from your pictures, we can say we are still in the recovery phase. There was some weather effects which were helpful, but we are still in recovery. Still stepping back a little bit, we are already seeing price levels which are over many years on a quite high level. Why is that? How do you bring this picture together?
Well, I think that this can be explained by several factors. Mm-hmm. If you look at the European market, we have a stronger than expected demand. And the numbers are actually astonishing. In the first 20 days of April, European gas consumption rose by over 30% year on year compared to last year. And of course, this is due to a number of factors, including the recovery in industrial gas demand, but also due to the colder than the normal temperatures. And so the demand is quite strong. It is, I think, unexpectedly strong for that period of the year. And on the supply side, I think that that in the European picture, it is important to highlight that we have a very, very strong maintenance season in Norway. And this is actually, it is stronger than usual, because some of the maintenance work, which was scheduled for 2020, because of the sanitary situation and the lockdowns, has been delayed to 2021. So, and this is why we don't necessarily see a strong recovery in Norwegian pipeline deliveries into Europe. And then I think that the third point is related a bit to the global LNG market. We see a very strong recovery in certain Asian markets, and here again I think that in particular China, which is partly driven by restocking needs, but I think it is mainly incremental demand. And when it comes to China, I think it is also important to highlight, which is not often mentioned, is that the Central Asian pipeline flows were actually below last year levels in the first quarter. And we see that the flows from Uzbekistan, from Kazakhstan, did not recover to pre-2019 levels. And the reason for that might be also due to upstream underperformance. So there is a strong pool of LNG also coming from China. And at the same time, there is a number of outages which are somewhat limiting energy supply. So I think that sort of those are the factors which are supporting these price levels, which are actually, if you look at JKM delivery for June, it is now above $8 per MMBTU.
Yeah.
So which,
following up on that, one element of the quite high prices we see right now is that the spread between spot and next winter is shrinking. It's quite on a low level right now. Expectations are driven by the storage expectations, or what is your view on that?
So I think that when we look at the European picture, again, the summer-winter spreads are practically non-existent anymore. They have fallen below $0.5 per MMBTU, which might be worrisome for some storage operators who maybe have a higher operating expenditures than that. I think that this is partly related to the fact that the sort of the summer contracts have been gaining more quickly and more strongly than the winter contracts. And the reason why the summer contracts have been gaining more strongly is partly because of the expectations around higher injection needs. So this is a bit of a counterintuitive paradox situation, but I think that we need to consider that injection needs have a pricing influence because during the gas summer season, injection demand can account for about 30% of the the total demand. So I think that this is one part of the story, and the second is that, again, I think that the demand so far has been stronger than expected, and this is partly weather driven.
On the opposite, we get quite some questions here on the long-term role of gas in Europe. We talk about the nuclear phase out and coal phase out. How's that affecting the role, first of all, and as well the price expectations? Are the prices more driven by the global picture overall, or does this shift within Europe is a major driver going forward?
So I think that the European energy market is undergoing a profound transformation. As you mentioned, we have the nuclear phase outs, we have the coal phase outs, lignite phase outs, and this puts natural gas into the position where it is going to become the backup for whether in an energy system which is dominated by variable renewables. And I think that this is going to have a very interesting effect on the pattern of gas consumption. In fact, if we look at some of the markets which are already sort of in that situation where we don't have much coal generation left, such as Belgium or the UK, we have seen that the volatility of gas to power demand has been increasing significantly in the last couple of years. Now, this higher volatility, of course, translates into a higher price volatility. So I don't want to go into price projections, but I think that the shape of how the price evolves is quite interesting, and I think that there is a clear move towards more volatility, which can have a lot of interesting implications in terms of asset investments. There might be an increasing interest towards salt caverns, which are a very good fit in sort of meeting short-term demand fluctuations, and we see that there is investments going into that facilities, for instance, in the United Kingdom. But I think that it is also going to reinforce the interest in sort of short-term trading and to hedge short-term positions.
So these opportunities come as well with quite, as you said, fluctuating prices between the different hubs within Europe. It's not all eyes are on TTF. There's as well some demand which is more regional and specific, but it creates as well some opportunities and some nice, interesting developments between the hubs, no?
Oh, exactly. And I think that when we look at how the infrastructure is also developing in Europe, the growth in terms of interconnectivity is also sort of facilitating these opportunities which arise between more local and more regional hubs, which are also growing in terms of liquidity, and which are also can be very well suited to sort of reflect on those short-term market fluctuations.
Yeah, and the new pipelines have definitely helped, and it will continue to influence the game, no?
Yes.
Yeah. All right, let me check. We have some. They're getting a little bit on a higher level again. You talked about contracts in LNG quickly. How is the interdependence between gas and the oil market today? How do you see that? Does that play a role in your scenarios?
So I think that there is a long history between oil and oil indexation and gas pricing in general. We know that it goes back to the 60s when Groningen was discovered, and actually when we look at the LNG trade, oil indexation still represents for about 60-70% of LNG trade. I think that it is a very interesting situation now, because what we see is that sort of the correlation between oil prices and spot prices is not that significant as it has been in the past. Actually, it has been statistically insignificant in recent years. But at the same time, we see that there is still a lot of appetite when it comes to oil indexed LNG contracts. And this is not necessarily something which is pushed solely by the suppliers. Sometimes it is also the buyers who are interested in those kind of contracts for many reasons, including the fact that the hedging strategies might be just easier when you have oil indexation in the contract. Now, I think that this is one side of the story. The other one is that if you have, what are the alternatives to oil indexation? It is either having a hybrid formula or having a spot or hub indexed long-term contract. Now, for having a hub indexed long-term contract, first of all, you need a hub you trust. And you are going to trust a hub which has a certain level of liquidity, a good churn rate ratio. And we don't necessarily see these kind of hubs yet in Asia. And I think that there are some initiatives, including in India, in China, but it takes time for them to gain maturity. The historical experience from North America or Europe shows that you need at least 10 years to have a liquid hub.
Yeah, and so on, it stays tied to oil. We get many questions around your price predictions. What is your view on? You said this is not the core of what you want to present, so I just tell it as well, or give that as a feedback to the audience. I think you don't want to make price predictions, don't you?
So yes, this is might be a bit. So we don't do price forecasts. We take the forward curve, and of course there's always some downside and upside risks which needs to be considered when we take into consideration those forward curves. But
yeah. So you do it for your outlooks, but not to predict really the prices directly. I understand that. Maybe getting closer to the end, we talked about recovery. It's a major theme. What are your expectations for Europe that when we'll be back and have fully recovered from the COVID crisis?
So I think that when we look at a short-term forecast, we expect that it is going to recover to pre-crisis levels this year. Again, and this is going to be partly driven by the rebounding economic activity, and also by the weather conditions, and we have seen that we had a very strong heating season. So this is obviously helping. The more medium-term picture is slightly different because we see that all the different trends, including the expansion of renewables, the efficiency gains in the residential and commercial sector, as well as some fuel switching dynamics in the industrial sector, are not going to just support an increase in natural gas demand. But I think that what is interesting is how the shape of gas demand is going to evolve. And here I think that it is rather clear that we are evolving towards more volatility in overall gas demand, which I think is an important trend to consider, both for infrastructure developers and for the trading community.
Exactly. That's a good last word. So interesting years ahead of us for the trading community. Thanks a lot, Greg. I learned again a lot about the market. It was really interesting listening to you. We got many more questions. Maybe you can pick up some and answer them via email or so if it's possible. Thanks a lot for your time, for the time of the participants. I hope to see you all back pretty soon with the next topic, and wish you all a great afternoon. Thanks a lot.
Many thanks, Hans. Have a great day. Bye.
Bye-bye.